Hello, this is Unit 9, Property Insurance Basics. For this unit, we get to put on our homeowners insurance agent's hat. Homeowners insurance agent's hat. Um, Again, remember to stay in our lane. I'm not an insurance agent. We're not in school to become an insurance agent. However, we're working with buyers and sellers that deal with insurance. So it's important that we understand the very basics of it. And the big part of this unit is at the end when we talk about our roles, the broker roles. So this is the entire Unit 9. In class, we kind of hit the highlights, but I just want to make sure you have the whole unit as you're preparing for that state exam. So with that being said, we're going to define some basic property insurance terms. We're going to talk about the difference in homeowners policies. So there's an HO3, 4, 6, etc., different policies. We're going to talk about flood insurance and try to determine when flood insurance is not required. And then, as mentioned, talk about our responsibility regarding the insurance. So the most common homeowners insurance policy is the HO3. This is a combination policy of property coverage as well as liability. So liability coverage would be for injuries by or to third parties on the property. Property insurance is covering the properties or the improvements. The reason the HO3 is the most common policy, if the buyer is getting a home loan, the lenders will require homeowners insurance, but they have minimum standards. So for most cases, the HO3 policy satisfies those minimum standards, those minimum requirements that the lender needs. So buyers agents, remember during your due diligence, you're having your buyers shop around for homeowners insurance because we want to make sure that they have time to select the policy. And then we got to have the lender approve it because that's part of the loan process. So we want to make sure that that all falls into place while we're still in due diligence. Another homeowners policy is the HO4. That's your renter's coverage or your tenant's insurance. The tenants will have insurance to cover their stuff. The landlord or the homeowner should have a policy to cover the structure of the unit, but the renters are going to have an HO4 policy, a renters or a tenants policy for their stuff. And then the other one is the HO6, which is your condo coverage, also referred to as a walls in policy. Remember, condo owners only own paint to paint or wall to wall or sheetrock to sheetrock. So it's not going to cover the exterior, any of the grounds. That should all be covered under the condos association's policy for the whole grounds. Vacant property. Vacant property is defined as one where the occupants and the stuff have moved out. You may have an unoccupied property, which would be just the occupants are out, the stuff is still there. But with a vacant property, the people and the stuff are gone. This is particularly important to my listing agents. At some point, your seller has to move out. And if it's a couple days before settlement, probably not a big deal. However, if it's weeks or months before settlement, we need to encourage our sellers to reach out to their homeowners insurance policy provider and report the property as vacant. Now, if they do that, their premiums will probably go up, but failure to do so, I mean, vacant properties are just more susceptible to damage, vandalism, that kind of thing, because there's nobody there watching it. There's nobody there occupying it. So if they don't, they say, man, I don't want to pay more premiums. I'm not going to call and tell my homeowner's insurance agent that. Okay, well, they need to understand that if something happens to the home while it's vacant and they didn't report it, the insurance company may not cover them. So best bet is to encourage them to reach out to their homeowner's insurance agent and report it as vacant. We all know I can't make anybody do anything, but I do want the documentation that I had that conversation with my seller to report that property as vacant. Now for my buyer's agents. Anytime as somebody is shopping around or looking into a homeowner's insurance policy, One thing that the homeowner's insurance agent will do is pull what's called a CLUE report. CLUE stands for Comprehensive Loss Underwriting Exchange. It's a database that goes back 7 years, and it lists 7 years of claims. And if the people and or the property have a lot of claims on the CLUE report, then their premiums may be higher. Again, buyer's agents, this is why I want your buyers shopping around for homeowners insurance while we are still in due diligence. If the homeowner's insurance exceeds their allowable monthly payment, remember, a 12th of that annual homeowner's insurance is part of your monthly payment, that second I of your PITI, principal and interest, taxes, and insurance. So if the homeowner's insurance is more than the allowable payment, then your buyer's not going to get loan approval. And as we've been saying, I mean, we never want to terminate. But as a buyer's agent, if we have to terminate, the best I can do is terminate within our due diligence, so I can get my buyer their earnest money back. And hear me, I'm telling you to have your buyers shop around. Please don't ever look at a buyer and say, this is the insurance agent you're going to use and you're going to like it. They're all created differently. They all offer different policies at different rates. So the best thing we can do is encourage them to shop around and determine which policy is best for them and approved by the lender. We may have a situation where your buyer moves in before closing or your seller stays after closing. This is negotiable between both parties. And in both situations, we got forms for these. So buyer possession before closing and seller possession after closing. The key in these forms, the big thing with these forms is that it requires or highly recommends 2 insurance policy. One party is acting as the homeowner, the other party is acting as the tenant. So we need to make sure that both parties are properly insured. It also goes over very basics. It's only like a page and a half. So it's really not a long-term lease. It's only meant for a short-term period, maybe a week, give or take. So other things we're going to discuss is the rent that whomever is acting as the tenant is paying, the party acting as the landlord, and who's going to maintain, who's responsible for lawn and utilities and that kind of thing. So very, very, very basic. If you need a longer term lease or something more in depth, we do have a pre-printed lease. We have a form for that you can use. But if that doesn't fit the needs of this situation, then we know that we need to have your buyers and sellers talk to their attorney to draft something up. Risk of loss. Risk of loss is on the seller until closing, until that brand new deed has recorded. The seller owns the property until that deed changes hands. So listing agents, we need to make sure that our sellers understand that they need to keep coverage. I have actually had sellers say, woohoo, we're under contract, I'm going to cancel homeowners insurance. Hold up, you still own the property. Under contract is closer to closing, but it's not closed yet. So it's worth having that conversation. If the house burns down while we're under contract, the risk of loss will be on the seller because they are still the owner. The buyer's insurance policy is going to start when that deed records. Once that deed records, and that is also when the seller can cancel theirs. Some properties might be in a flood zone, susceptible to flood insurance. First off, we can look at a FEMA map to determine if the property might be in a flood zone. Now, just because it's in a flood zone doesn't mean that flood insurance is required. There's like this little algorithm that insurance agents use to determine if flood insurance is required, and if so, how much. All of that comes from FEMA. So while we are encouraging our buyers to shop around for homeowners insurance, understand that flood policy is what it is across the board. So if they have to have it, if it needs to be added, then the insurance agent will go to that little algorithm and it'll determine like the age of the building, the location to the threat of the flood. So is it near a creek or a stream or a river, lake, pond, any of those bodies of water that might flood? So it's a separate insurance policy, and it's only for those that the insurance agent and or lender determines that flood insurance should be covered. Again, what we can do before we even write up the offer or list the property, we can go check out FEMA's flood maps and see if it looks like it's going to be close, have that conversation. Again, I'm thinking of those buyers that are about maxed out of their payment, and flood insurance is not cheap. So if you tack flood insurance on and it's more than their allowable monthly payment, we're not going to get loan approval. We'll have to terminate. Best thing to do is terminate during due diligence. Here's just kind of a sample of a FEMA flood map. So many different sources out there to check out. Your multiple listing may have a quick map you can look at. And again, I'm not looking at buyers and saying, whoa, it's in a flood zone. I'm saying based on this map, it might be in a flood zone. Do you want to proceed with this contract? If they're maxed out, if they're at the top of their allowable loan amount, then they may not want to continue with this property. So I'm just trying to do a quick peek before I write the offer up. If the property is in a flood zone, it's a material fact. But remember, there's a difference in a flood zone versus paying flood insurance. So listing agents, if it's in a flood zone, you look at that map and you report that. That's a material fact. Buyer's agents, we need to take it a step further and determine flood if flood insurance is required. Some of the verbiage that they use, they may refer to a 100-year floodplain. That does not mean that flooding happens once every 100 years. What a 100-year floodplain means is that this area has a 1% chance of flooding each year. Flood maps change. You know, we see areas that in times of lots and lots and lots and lots of rain, we see areas, you hear people say, it's never flooded before. Well, it has now. So now it's in a 100-year floodplain because now we know there is a 1% chance that it floods or could flood every year. So again, just some FEMA verbiage. So let's bring this home. What's all this mean to us? Well, we need to advise our buyers and sellers to talk to their insurance agent to make sure that they're getting the best coverage. Please make sure, listing agents, you're telling your sellers to report the home as vacant. What they do with that information is up to them. I can't call and report it for them. I won't call and report it for them. However, we do want to make sure we have that conversation documented because heaven forbid something happens to the home while it's vacant. Insurance says, well, you didn't tell us, so we didn't know to give you that coverage. I don't want the sellers coming after you. So just make sure you document that conversation. Also, remember to tell your sellers that the risk of loss is on them through closing. So they've got to keep that homeowner's insurance until that deed changes hands, until it's no longer theirs. Very short and sweet with Unit 9. Again, help you prepare for that end of class, that state exam. If you have any questions, let me know.